Hi everyone, my name is Zee Razaq and welcome to the Next Level Finance podcast sponsored by Certax Accounting, and the aspiration is to unlock financial freedom, and I mean real financial freedom. This is episode 2 of the Next Level Finance podcast. We've got Peter, who's an insolvency specialist, and he's going to be talking through why he can be your best friend in tricky situations, working with your accountant tax advisor. So we're going to have a huge amount of value for different types of businesses, and thank you for listening. Hi Peter, how are you doing?
I'm good, thank you. Yourself?
Yeah, thank you for coming down, and I'm going to chat to the audience. This is going to go across all our social media, and we love giving value, as everyone knows, and this is why we're doing the Next Level Finance podcast sponsored by Certax, which helps you unlock financial freedom. Had to get that part in. Right, Peter, so let's start, Jim. We had obviously a nice little lunch and got ourselves into it, and we're going to cover quite a few topics today. So the first thing I really want to ask is, and we always ask everyone, is how did you end up being an insolvency administrator? Because when you start your life, I'm sure that wasn't the goal, was it?
Absolutely not. No, I mean, it's one of those things. It's one of those professions that very few people know exist, and it's something that I kind of fell into, really. So I began life wanted to be an architect.
Wow.
I went and got my degree, and the 07-08 recession got me.
Wow.
So yeah, I began in doing a bit of accounts. I didn't enjoy audit like most people up and down the land, and thought there must be something more exciting in life, and yeah, just fell across the opportunity to enter into the world of insolvency. It's been 15 years and I haven't looked back.
Wow, that's amazing. And also, have you just been with one firm, or have you moved around, or how long have you been?
I began as a trainee, and stuck with the same firm, worked my way up. It's been an interesting journey.
That's amazing. So 15 years with one firm,
yeah,
and you've worked from the bottom to one of the partners, right?
Correct, yes.
And how long have you been one of the partners now for?
I passed the Joint Insolvency Exam Board, which is the qualification that you need in order to take appointments in the UK and Northern Ireland in 2016, and I was made a partner in 2017.
That's amazing. And how many partners is there?
We're a 4-partner firm.
Wow. And as you were mentioning, it, like every business, there's the ups and downs. And it's a bit, insolvency, it's a bit mad in the sense when the economy is struggling, that tends to be the best time for you guys generally, in the sense trying to help.
You're right. Insolvency is cyclical. However, where the economy is very buoyant, what you have is natural competition, survival of the fittest. So then you do have companies that require restructuring, companies that require entry into liquidation. On the flip side of that, when times are tough, then it's formerly businesses that were viable that, as a result of, be it the credit crunch, be it, where we are now in the current economic climate, that get sent over the edge. So, I mean, insolvency is a necessary part of a thriving economy. Whether you like us or not, as insolvency practitioners, and it's a very small profession. There's only 2,000 of us in the whole of the UK. Only 12 fully qualified practitioners entered into the world of insolvency last year. So it's a tough place to be, because insolvency by its nature is very complicated. Coupled with the fact that I think unnecessarily so, it's legalese. Insolvency is the main phrases that we use are Latin. Things haven't really. It's not 21st, 20. It's not for the digital age.
It's funny.
That's for sure.
It's funny that you say that. That's same with accountancy and tax and the legislation. There's quite a few things, and especially in our legal infrastructure as well. A lot of Latin terms. You just have to deal with them just how it is historically.
It's a different language, and it doesn't need to be so.
Absolutely. And I think you've highlighted that a lot of people don't know is the key bit of a liquidator or an insolvency administrator is to add value. And I think a lot of people, just like accountancy, they don't understand that because they just see a particular process. They don't see the end to end. And I think that's probably some of the challenges that we're going to talk about when you've had going through your career is, how do you communicate that part of that journey? And that's the skills I guess you have to learn, right?
Most definitely. I think the most important skill set is being able to explain complex financial information in a very simple and straightforward manner. The insolvency legislation gives insolvency practitioners many different tools, many different processes to rescue a company, to close a company, and it can be quite burdensome if you aren't presented as a director, if you aren't presented with a very clear run through of what those options are, how it may affect the business and all the other stakeholders. So most important part of the job.
Yeah, I think it's really good. And I think one of the things that I know when I met you a few years ago is you're very good and you're very approachable to, and as you know, the power of network. Tell us a bit how you found that as a difference from being an employee, I guess, and becoming a partner and have to be business facing.
Sure. So that transition, one of the things that you're never taught in school is, well, actually, there's a lot of things you're not taught in school. And I mean, the last time I used long division or algebra, I don't know. But, you're not taught real life. You're not taught mortgages. You're not taught finance. You're not taught how to be a director. You're not taught how to run a company. And you're not taught how to present yourself to the outside world, and one of the key things is making sure that you find space for yourself in the world. I'm thinking my business, for example, grows off of referrals from other accountants. My job is to help the accountants out there better service their clients, those that are in difficulty. And to be able to do that, I have to find my own niche, my own identity, how I can help you, Zee, protect your clients, to assist them when they're at their time of need.
And I think you've made a really good point. It's being able to put your unique offering, i.e. yourself, that personal brand, and then how you communicate it via the business brand, which we were talking about before, because they are two different things. And I think a lot of entrepreneurs find it a struggle, because if you haven't got a personal brand, i.e. people don't know who you are, you're not going to be successful, and you have to build that. And then you have to also understand the business culture and how to blend that to promote the business culture, because you need to do both to have a successful business.
100%.
And I think that's an interesting point that you've made there. What I want to do, I guess my question to you is, how did you find your unique niche and your unique identity? And the reason why I asked that is a lot of people struggle with that. So how did you say, look, this is what I want to know in the marketplace from personally and our business offering that I want to be leading on?
So for me, it came quite naturally because of my background. I've just got a completely different background to 99.9% of all other practitioners out there. So I do see things in a slightly different way. When I'm sat in front of clients, I am naturally very visual in the way that I explain things. So it's often with a piece of paper. It's often me drawing through the scenarios and just really keeping it as simple as possible. So going back to, doing a drawing as an architect, each and every line that you put on that piece of paper needs to have a purpose. I think the same thing is with words. You pick and choose the words that you use. You tailor them to the audience that you have in front of you. And it's about being adaptable. Something that's complex to be presented in a very simple and straightforward way to enable people to make the right decision.
Absolutely.
In terms of my personality, I like to just keep things simple as possible. And that's just naturally who I am, how I operate as a practitioner.
Really great value, and I hope the audience enjoy it. Now, is whichever business you're involved in, especially if you're owner-managed business, these are the fundamentals of success. Understanding what you stand for and what you want to be known for, very important. The next bit I want to do sort of speak about is that you mentioned some case studies, and I know we've had the odd client, unfortunately, that has had to go through a process, and it's been quite a good process, the feedback we've had, hence why we've got you on the Next Level Finance podcast.
Thank you very much.
I wanted to know, what is one of your favourite processes, i.e.
Sure.
restructuring the business
Yeah.
through insolvency.
Yeah.
So give us a bit of an example what you've
So
done.
I'd link that to job satisfaction. Why do I do what I do?
Hmm.
I enjoy doing what I do where I can help people. Sometimes it's to rescue a business, and that's definitely where I get the most satisfaction. One actually from the back end of last year, it was rescuing a company, a 50-year-old company.
Wow.
It'd been going strong up until the pandemic, where they put together trucks. The pandemic created a whole bunch of issues with the supply chain, so they weren't able to deliver the vehicles that had been ordered, resulting in huge cash flow problems and a really substantial debt to HMRC. We're talking just over 7 figures.
Wow.
There were 50 jobs, 55 jobs on the line just before
Wow.
Christmas. We were able to rescue the company via a process called a CVA, Creditors Voluntary Arrangement. So what it was this business is viable. We've prepared the cash flows. We can see that the order book is strong, but it's the debt that the company had been carrying on its shoulders for the last 2 or 3 years that had basically crippled the company. So we presented to the creditors, and namely to HMRC, to say, give us the breathing space. This company, over the next 5 years, will repay back, I think it's £15,000-20,000 a month, each and every month, and that will repay all of its creditors within the next 5 years. The alternative is that the company goes into liquidation, and HMRC had their finger on the button to wind the company up at the courts, and that was approved on just before Christmas.
Wow.
And the creditors meeting at that, I took in the delivery room. Well, my son had been born the day before, and we were still in hospital waiting to be discharged.
Wow.
And we held that creditors meeting. It was approved by creditors, and by far and away, the most satisfaction you can get in insolvency, I guess. I was about to say standing up,
But do you know what? That is actually an amazing story. So you had a major family event having your son. Congratulations.
Thank you very much.
And then you dealt with one of these cases where you protected a business for 50-year-old business. And this is where people don't realise why having a good person who knows how to restructure businesses in the insolvency part of the industry is so important, because there's certain things that Peter can do that an accountant, tax advisor, business advisor cannot do. And this is why they work in combination together to make sure they give the best outcome to the client. And that was an amazing outcome, because you've kept a business going, which is strong. It just needs restructuring, and you were able to communicate as an independent, impartial person, a business, and then get buy-in from our friends in HMRC if they're watching, which is amazing.
One thing that I would add, Zee, is the importance of having a strong relationship. So this wouldn't have got over the line in the way that it did without my relationship with the company's accountant. We were able to put together cash flow forecasts, stress test them, model them based on various scenarios, which is what HMRC would have wanted to see. We had to do this in quick time because HMRC's threat on the winding up petition. So if we come back to your original question of, what makes you unique, what makes your business unique, it would be those strong relationships with our stakeholders. It's what differentiates, small firms who care but are able to still deliver, and the bigger tier firms which don't work for SMEs.
I think you've hit the nail on the head, and this is across the board. I find is that this is where the competitive advantage of smaller businesses. When I say smaller, relative smaller businesses, because they can have that quick turnaround, support the person. You're not like a factory processing unit, and this is where unfortunately bigger businesses end up becoming, and they just literally processing one after another. You're just a name and a number, and there's no service. You don't know about the people, the impacts on their lives, and this is how you bridge it, which is amazing value, and that's a difference maker. I think the other bit that I wanted to just highlight to people, you've done hundreds of these over the years, haven't you? Hundreds of restructures, and that one obviously stuck by because of the personal and business nature. I think another thing, just to be clear to the audience, is Peter and his firm looked generally look at owner managed businesses below the audit threshold. The audit threshold is like 10.2 million. Annual turnover is one of the criterias. I think it's 5.1 million on the balance sheet, or average of 50 employees. So if they meet two of those criteria, they're considered audit, and Peter can deal with those, but these are organisation tends to deal with smaller ones, more family run businesses.
Yeah.
Is that fair?
Yeah, very much so.
Perfect. What I want to get onto, and you sort of talked about, is relationships and your approach, which I know for my own personal experience is quite big, because we've had clients where they've had to close their business for a number of reasons, and given Peter a call and said, look, we need to liaise with clients, get all the formalities and do it in the best outcome, and that's the pre-work, Peter's work, and making sure when the post-completion is done, it's all communicated and got all the stakeholders and stuff. So I think it's been quite, and that's where the relationships are so important. I guess for me, one of the big things is people don't really understand insolvency. I'll be honest with you. You know, even us in the industry, we tend to see that near the end outcome rather than thinking that's one part of the toolbox.
Yes.
And I think that's how you've got to look at this, because sometimes it's inevitable, but we need to make sure we know if it's coming, how to make sure we get the best outcome. And I guess that's where you come from.
I probably sound like a doctor here when it's, you know, you want to get an early diagnosis. If you've got a problem, a business problem, then it's best to have an early conversation than bury your head in the sand and leave it, you know, last minute, in which case the options available are much narrower. So, you know, my suggestion to your clients is where they're not particularly comfortable with the direction of the business, they've got, you know, a balance sheet that isn't particularly healthy, looking at the forward order book, looking at the cash flows, looking at the forecasting, things are uncomfortable. Then, you know, I'd like to think they come to approach you, and at that point, you know, you pick up the phone to me, and we would sit down and meet with them, see what the options that are available, whether, you know, the business can be restructured in a certain way, whether there's liabilities that are an issue, or if it's a more fundamental issue. Is it a case of, you know, closing the business down now rather than the directors putting in a whole bunch of money, throwing good money after bad, if the ultimate end goal is still going to be going into liquidation? But, you know, if you can see that sooner, it's you know, obviously better to take action. So early diagnosis.
I think that is a really important point Peter's made, and this is something that I've been harping on. If you hear me on LinkedIn and YouTube and all the different social medias, one of the most important things is looking forward. So many people who run their businesses, and the support they get from their accountant, tax advisors, business advisors is historical, and it's not as valuable. The valuable in this is being able to understand where you are and get a forward-looking view, especially before year-end, forecasting, financial performance, cash, tax, all these things, and then putting in your long-term objectives, talking to your team to improve performance. You can only do that if you know what the financials are. And I think this is the challenge we've got in the industry, because loads of people are like, what do I need to just provide HMRC and the government? They don't look at what their business needs. And that's what you're trying to really illustrate. I guess the bit that I think a lot of people probably get a lot of value in is just, could you just run through like the key different types of restructuring insolvencies that you go through?
So we've got a business rescue, prime example being the CVA that I mentioned earlier. It's where the directors stay in office and the business continues and pays an amount back every month to try and settle those debts.
Just to clarify, CVA, creditors voluntary
arrangement.
Okay.
The other is still a rescue. And you often see this in the news, where a company is entered into administration. What that means is the business still continues, but someone like myself, a licensed insolvency practitioner, will step in with the protection of the court and continue to trade the company with a view to selling it on as a going concern.
Okay.
There's a slight...
Just to clarify for the audience, going concern is basically a trading entity. The word is used as a going concern, and you might see it in your accounts. So that's what Peter means.
Thank you. A slight variation of that is what's known as a pre-pack. It's where an agreement to sell the business happens before placing the company into administration, because it's not possible to run that business. There may not be enough cash to be able to trade the business. There might be licensing issues that result in it not being able to be traded in administration.
Okay.
So those are the rescues.
Yeah.
That's where the business stays intact, employee jobs are safeguarded.
Perfect.
Outside of that, you've got insolvent liquidation, often known as a CVL, which is a creditor's voluntary liquidation. That accounts for the majority of companies going into some form of procedure. And then you've got solvent companies which enter into a member's voluntary liquidation. So there tends to be no creditors on those. It's just the company assets being distributed to the company shareholders.
And I think, especially on the last one, MVL, I'm going to dig a bit deeper in that one.
Sure.
It's the value that you guys create. A lot of people don't realise doing an MVL potentially is quite tax advantageous, especially if you're a trading business, because obviously when you close it, provided you meet the criteria, you can claim, always got a bit of a tongue twister name these days, business asset disposal relief.
That's the one, yeah.
Better known as entrepreneurs relief. I always call it entrepreneurs relief, as anyone will probably see me on Sky and all different places. That's how I call it, because everyone knows, because you're an entrepreneur and that's the relief you get. So you can take advantage of that, and also different ways how you can get the money out in a tax efficient way without causing yourself problems. But there is one drawback, isn't it? Quite a big drawback to MVLs.
Well, I would say that as a process, it's great for directors and shareholders because it gives the company finality. What you could do, there's always an option, and the option to every director is do nothing. So even if you're in financial difficulty, the first option is just do nothing. Sometimes that's the right answer. More often than not, it isn't. In a solvent situation, the doing nothing is we'll stop trading the business, we'll stop operating, and then we extract all the money as a dividend. And that could work, and that could be absolutely fine. But there's no finality to that situation, because you then have to apply for a voluntary strike-off. If there's some HMRC debt or something down the line that crops up, that creditor would apply to court to reinstate the company, and that headache then comes back. Whilst in a member's voluntary liquidation, because someone like myself is appointed to oversee the process, we advertise for claims in the London Gazette, and once that deadline is passed, creditors can no longer claim. You often then deal with all the problems that would have come out the woodwork as part of the process. The shareholders receive the benefit of the assets of the company. Where applicable, they can apply for the relief, as you mentioned. It's a cleaner process, headache-free, and there are tax benefits as a byproduct for the shareholders.
So touching on 2 points on that. One is obviously the extraction of money. Dividends generally probably isn't always the best bit when someone's over the basic rate income amount, which is currently about just over £50,000 a year. So therefore, entrepreneurs relief becomes a lot more tax efficient, and that's what you enable. I guess the second bit that I really want to touch on is that you can't just close businesses in this way and then open them the next day. There's a period of time.
There is, So under the TAR rules, I believe it's 2 years.
It's 2 years, and I think that's quite important for entrepreneurs to know. Generally, this MVL is used for when people want to close a business and move to a different direction. It used to be a lot of people when they want to retire, and that's a common way. Or they've said, look, let's give an example. They're IT contractor, they've had fun with IR35, and you'll love this scenario, and then they come and they're like, do you know what, we need to go in PAYE for umbrella, this limited company is not relevant anymore, can we close it and extract all our money out? That's a fair one. And then you can go on umbrella, carry on working. That's no issues because you're not setting up another limited company in the same thing. So I think that's quite important. I guess for me, one of the big impacts is the different types of businesses. Because as people following us on LinkedIn, they will realise we have got different types of businesses coming. We've got property developers, property investors, even some people in construction businesses, and we have people who run general trading businesses. The impact and the valuation is so important, isn't it? Because they've got different challenges and issues that you need to deal with before you start any of these processes.
Yeah, spot on. Each case that I deal with, each company that I deal with, has its own unique problem, shall we say? You know, no one company, no one balance sheet are the same, and different industries have different problems. I'd say for property developers, property investors who are part of your client portfolio, they tend to do fairly well because they're in control of their own destiny. You do a development, all being well, touch wood, it's profitable, and you move on to the next one, and that ordinarily will continue. The property developments that do go wrong are usually tied to a contractor issue, and it's by no means a coincidence that the highest insolvency rates in the UK are for the construction industry. So those working in and around construction, you need to be wary of the signs. I'd say before jumping into bed with a contractor, you want to do your due diligence. You want to be comfortable of their financial standing, where they're at, because most of the developer insolvencies that I've seen, all the issues that have come about, are as a result of a main contractor somewhere going bust, or actually something that's even less out of everybody's control is a couple of subcontractors within that same project also going pop, and it just happens to be that all it's like a pack of cards in construction, and it can all just fall away.
I think you've touched on some great points about how you set up technical word JCT contracts, how you set them up with your construction organisation or your builder as a property developer, because if you don't get it with a firm that can handle this and has got a good track record, you're opening yourself up and you could lose your asset in the process. I guess one of the things that property developers have different aspects, they consider it a trading business because they're building properties or converting them or whatever work they're doing or adding value. The whole point of it is a stock. So they're going to sell it. It's not to hold like an investor. So the tax fund, because we love tax, as everyone knows, is a lot more beneficial for property developers. Whereas property investors, they're treated very differently for tax. And I think we were having a chat about this. You have to be very careful with those around what actions you take, because they can be quite challenging to get money out because they don't get the same exits which
as a trading entity.
Like a property developer. I guess I know you were talking about some of those ones. I think you were mentioning that one of the big issues is offshore and onshore.
Correct,
where the shareholder is based.
Where the shareholder's based, and also potentially if you're liquidating the company, where the liquidator's based. Because it could be that the minute it goes into liquidation, the control of the company moves to the liquidator, and if the liquidator's based in the UK, there is a risk. So there are times that we do joint appointments with other practitioners in the BVI, for example, or wherever the company itself, Panama a couple of years ago, was quite prevalent in de-enveloping properties that were invested within the context of limited company and using an MVL to unwind. So it's one of those where you full on have to get early advice, and it probably will require specialist tax advice as well as specialist insolvency advice, so that you can model the outcome, and so the outcome that you're looking for, you have some certainty over.
Hope you're enjoying the podcast. Sorry to interrupt. we're just giving some bit more insight. Below this, you can actually subscribe to our newsletter or download some free guides, which we recommend. And if you feel you need more advice, please do get in touch. Our details are below. It's inquiries@certax.co.uk. And I'm going to let you get back to the podcast. You've raised a very fantastic point. It's quite complex, and it depends on where the company is based, if it's a limited company that owns the assets, as well as the individual. Mm-hmm. Because there's both impacts, isn't it? There's the company implications, which we're talking about, and we'll get onto the individual implications in a bit. I think that the big, I guess, what is your, bread and butter? What are the ones that, you niche on, you get all day long? I know we touched on earlier in the podcast, the ones that you see quite a lot, especially right now. So
right now, I'd say 80% of my appointments are as a liquidator, insolvent companies, predominantly, say, 100 grand worth of debt, usually a bounce back loan and some HMRC debt. The directors have done whatever they can to trade through COVID, but coming out on the other side, it is a different world. And so what worked before may not necessarily work now. And those companies may have run out of money, may have run out of direction, run out of puff, and they're just being placed into liquidation. Because at some point, when the business is no longer making money, you're no longer able to put quote unquote food on the table. At that point that business is a headache, and you do need to seek advice on your next steps forward.
I think you've really covered quite a lot there, and let me try to unpack that. Your business, first of all, you need to look at the stability of the business, especially what we call the balance sheet, that bit that you probably don't look for in your accounts, but quite important because that's your health of your business. And this is where Peter, initial aspects with Peter and his firm is they look at that. They also look at the financial performance, i.e. how well is the business doing, how quick is it receiving cash, what for the sales they've got in their order book, depending on what type of business they are, and can they actually see it in a potential perspective to save it first. That is the way that you go first, is can we save this business, protect it as a going concern, i.e. it's a viable business. That's their first point of call before they think about other measures that we spoke about earlier. And that is a really good way of a good approach. Unfortunately, many people probably think of insolvency people, they probably think, oh, they're just there to close my business but no, that's not been the case. I know from my experience talking to you, a number of stuff, we've saved so many businesses that have carried on going because we've been able to get advice and tell them, in a bit of time ahead, because of the work we've done, is we know where they're going and they've got to change direction, and if they can change direction, then it's a positive outcome of that business going.
Agreed. It's what we spoke about earlier about getting early advice. I'd say of the conversations that we've had with your clients, the ones that have been early, preemptive, don't necessarily need a formal insolvency procedure. There are ones that, where we're looking at it and it's quite stark and quite clear that the business has reached the end of its life and it's a straightforward liquidation. It is just about stepping outside of the bubble that is, your company, and reaching out so that, an objective decision can be made on what the best route is. And it also depends on what the directors want to achieve. There's times that there's a viable business, but the directors are saying to me, Peter, I can't handle this business anymore. It's killing me. It's literally killing me. At that point then, there's no point talking about entering into the CVA that we spoke about, where you've got to run the business profitably for the next 5 years to pay off the old debt, because the strain on the individual is huge. You've got to have that commitment and that desire, and it's okay not to have it, in which case it's a different procedure. Not because the business says it can't be done, but actually, when you speak to the people involved, it can't be done.
I think you've hit the nail ahead of there. It's really talking about the individuals, understanding what the directors, because there's two parts to it. It's what the business health is and what the individual's mindset is, and what their circumstances are. And that really leads us nicely on to talk about the individual. But before we do, there's one question I just want to, I know a lot of the audience will probably be thinking is,
Sure, far away.
what is the criteria generally for liquidation when it becomes compulsory to speak to an insolvency?
Sure. I put the compulsory bit as to leaving it absolutely to the last minute, and that's usually when there's creditor pressure.
Yeah.
That's usually going to come from HMRC.
Yeah.
It'll be a letter after various demands threatening a winding up petition, which is basically where the HMRC solicitor goes to court and they file, the judge passes a motion that the company is then placed into liquidation.
Yeah.
It can happen just like that, completely out of the director's hands.
Right.
Creditors can also do that when enforcing a CCJ or any other form of judgment after a statutory demand is issued, which is basically a piece of paper served on the company. You've got 21 days to pay your debt, and if you don't, then it can go to court, and then the company be closed, wound up there and then on that day. Creditor pressure generally, so where there's been a judgment, a High Court enforcement officer can be appointed. That'll be the knock on the door where they're threatened to take laptops and other assets to sell to pay the debt. You don't want to leave it to that point. I think more often than not, those scenarios that I presented to you, if you wind back 3 months, it's at that point that would have been obvious that there wasn't enough money to pay those debts, and that this was coming. It's at that point, that the conversation should be had.
So I think that's really great advice and huge value. Thank you for that. For me, I guess one of the things for any accountants watching or businesses looking at their balance sheet, there's certain things. So if your reserves are over 25,000, I believe that's the threshold normally, on a positive bit, that if there's a credit balance an asset balance of 25 net assets, then you have to get an insolvency administrator, because an accountant can't actually close the business.
For that would be if you're looking to close the company by way of drawing out the reserves in an MVL, up to 25,000 discretionary, the old ESC 16. I'm not entirely sure what it's called now, but you can extract that.
DSO 1.
Okay, and then close the business that way. Alternatively, if there's more funds than that, specifically if you've got assets, and I'm going to throw some Latin in now, which you want distributed in specie, which basically means, let's say you've got 10 grand cash and a property sat on your balance sheet. If the shareholders want that property, it can be distributed to them on paper rather than physically having to sell it to the shareholders. It's just transferred out by way of a distribution, the same way that cash is. And that's where placing it into liquidation is beneficial, where you've got assets that you want to distribute to the shareholders, especially when it's other than cash. That's
a really great point. And I think the other bit that a lot of people want clarification, that's when you've got assets and the business is worth something over 25. The other bit is when you've got any debt. And I believe, and I think you might clarify on this, I believe it's any loan, especially if they're over 10 grand, there's certain numbers that we have where you must get an insolvency person in, otherwise you can't close the business.
Sure, yeah. So without sounding too much like the Grim Reaper, the DSO1, which is the strike-off action, is only available to directors where there are no liabilities, zero. If you try to strike off a company with debts, it's actually a criminal offence. And we actually saw someone convicted on that point where they'd had a bounce back loan and they applied for a voluntary strike off of the business. They ended up with a 2-year jail term. There were some other nuances regarding issues with the bounce back loan, and that's why it was a jail term. But definitely take advice.
Really important, and I think the debt thresholds, especially where people have taken bounce backs, which tend to be 50,000 or whatever they are at the time, or CBLs, the crime finance, those loans are quite substantial, or any debt. Even I've had cases where the debt is actually to the director who's lent loads of money to the business. That if they can't take the money out, even if it's them lent the money, they have to go through this process, which is really strange. But this is the differentiation, isn't it?
Yeah.
I guess two things that come up to me straight away, which is an issue. One, which we touched, is the bounce back loan. If I can get your thoughts on that,
Sure.
and then I'll ask you the second one.
Sure. So very, very big talking point, not just in insolvency, but it's in the news. It was in the news more last year about bounce back loans, how much it's cost UK PLC, how many of those loans have gone bad and have defaulted, and that pressure has made its way into the insolvency industry, whereby the insolvency service, which is effectively the regulator of insolvency, and that all practitioners, when they're appointed on a company where it's insolvent, they have to report to the insolvency service on the conduct of the directors. And there has been a distinct change in the direction on reporting for bounce back loans, because there is a double down on bounce back loan fraud. So there's two things to consider, and fraud is a very loose term. It's an open term in my book, because there's knowingly doing it and doing it by accident. And there's different thresholds. So the bounce back loan application turnover in 2019 needed to be 4 times the loan being applied for. Quite nuanced, because we're talking peak COVID now. Everyone's stuck in their homes. You can't necessarily get access to your accountant. You can't necessarily get access to your records for those that are still not on the cloud. And it wasn't particularly clear that they were referring to the calendar year 2019 as opposed to the year ending some point in 2019. And the second part of the bounce back loan issue really is that the loan needed to have been used for the economic benefit of the business. And sadly, there are some rather interesting and colourful examples of what was not within the spirit of that. So buying a new car, going on holiday, pocketing all the money, prime examples of what that was not supposed to be used for.
I'm going to unpack that, because it's such a big issue, and I know the audience will love to get a bit of thing. The first part, it was a forecast, not just what you actually received. Very important distinction, because that was stated by all the banks.
With the forecast, though, the forecast can only be used for those that weren't trading for the full 2019.
But the thing is, the reason why they had the forecast was that people's businesses were affected, right? And they could then forecast what performance. And I think that was what a lot of banks were stating on their forms.
Yes, and each bank had a slightly different approach. And what shocks me is that the banks did no due diligence.
I think
absolutely none.
Without defending the banks, and a couple of times they'll say, "Oh, Zee's defending banks." I'm not defending the banks. I've been in the banking sector. They were under a lot of pressure from the government to get funds out, because businesses were literally going to disappear. Because this unprecedented aspect. So that's why they put this forecast aspect in, so people could see if they feel their performance would have been up to that amount, and they could justify that. That was what they put on the self-declaration. I think the biggest challenge, is the second item that you mentioned, because you can't get confused that you're going and buying a car. And and how is that value going to be to the business? Or you've pulled out the money via dividends, and it can be illustrated that it was that cash that was getting you paid, not future income or other income that you made.
What I would say is that there are considerations and reporting requirements, but realistically, if the bounce back loan is repaid, then there's no detriment. If there's no detriment, there's no issue. But when you enter into liquidation, and these issues then do come forward, so that's part of the conversation that we would have. Because if the answer is that there's an issue here, then liquidation may not be the best way forward. It may just be repaying back the bounce back loan, if that's indeed the only creditor.
I think that's the really important advice that I think Peter's given to our audience, is that you have to know what the implications are of what you're doing before you do it.
Yeah.
So get advice from people that are impartial, that are looking for your interest, in case you've made an error or you misunderstood it.
Yep.
Because a lot of people misunderstand it. Even me and Peter have got a different view
we do.
on it.
We do.
And this
We
is
do.
going to be debating across for many years. But
Yeah.
one thing I'm in total agreement with Peter is, if you try to become insolvent and you've got a debt and there's any question mark how you receive that money, don't become insolvent or close your company. That's the advice, I think, quite clear. But get an evaluation and make sure that you do the things correctly going forward.
Yeah.
The other bit I want to touch, and this is the bit that people really struggle with, is the director's responsibilities on insolvency.
Yeah.
And the reason why I'm raising this thing is because many people don't know, if you owe money to the company, you are personally liable.
You are.
And the limited liability is put to one side in
Yeah.
those cases. Is that correct?
That's correct. So, directors' loan accounts are very important. It's usually one of the measures that would indicate, is this business healthy? If it's relying on the owner having to putting money into the business, and that debt to the owner or whoever it is that's loaning the money, often the director, gets larger and larger. Where's this business going? Where is this going?
I was more thinking about the other way, where the director's taken too much money out.
Right.
So they've got a net debt to the company. Because many people feel those are normally the warning signs that they're going to close the business.
Sure.
But if they've got money outstanding, they're personally liable, aren't they?
They like any debt, you have to repay back what you owe, especially where the amount the director owes to the company is what's known as, in accounting word, material, i.e., if it was repaid back, the company would be healthy or would be able to repay back HMRC, who are preferential in insolvency proceedings. There could be an argument to say, if it's so big, it's the directors that have taken so much money out that has caused the insolvency of the company. That's potentially a big problem.
I guess, is there like a number amount? Is it over a certain amount, or is it any debt?
It's a straightforward debt, Zee. If I lend you a tenner and I'm made bankrupt, you still owe me that tenner. It still needs to be repaid.
Really important point, and I wanted to get that out from Peter, because that is where really good management, good MI provided management information to the client, and them understanding the implications of their decisions, so important. I guess the other bit I wanted to touch is something that you brought up quite nicely, was the trading or wrongful trading of a business. Explain what you mean by wrongful trading.
So if we go back to the do nothing option, the biggest risk of doing nothing is that you make the situation worse.
Wow.
So wrongful trading is where the director knew or ought to have known that at a certain point the company had no option but to enter into insolvency.
Wow.
So let's say you and I are looking at a client set of accounts and there are no reserves. We're looking at the future orders, all the sales, and we can see that there's not enough money coming in to pay what's got to come out. It's fairly clear in my mind that at that point the company's balance sheet is unhealthy and it's got cash flow issues. So I would say that the point of insolvency would be, at that point. If you do nothing, you continue to trade, and the creditors, the people you owe money to, that list gets longer and the numbers get bigger. That's a result of the directors not taking the decision to close the company at that time.
Wow.
And so they could potentially be personally liable for an increase in those creditors by not taking the appropriate decision at the right time.
I guess, what timescale are they looking at? So if I've got, say, imagine the business is 100 grand in debt, right? And it's only come to my attention right now, but I feel, being an entrepreneur, I can save it, because of the economic cycle, how it is. But 6 months down the line, it's got to 200. Are we saying that because it's come to my attention that it was 100,000, that 100,000 uplift, I could be personally liable or implicated, even though
a lot more nuanced than that. So my advice to that at that moment in time, when you're looking at it, it's 100 grand in debt, the option is continue as I am, and then it needs to be justified. So I'm going to inject X amount. I've got a large contract coming in. and the climate's, I see the climate changing. I can fund the business for another 3 months. I document that in some board minutes. I do a cash flow forecast, which shows that in 6 months' time, I think I'm going to be here.
Yeah.
Right? There's some justification to the approach that you've taken. Okay. If it's head down, it's quite clear that nothing was going to change. Yeah. There was no forecasting done, and all that's happened is instead of the company going down owing 100, it's owed 200, and there's an element of negligence on the director's front. Wow. Should they ought to have known. Yeah. So let's say the company had this hypothetical £100,000 liability. The company had one contract, and that contract got cancelled. Yeah. And the work that you were doing could only be for that one client. Yeah. There's no future prospects of this business. Yeah. So you've got no option but to close it. Wow. If you continue keeping it open and the 100 comes to 200, I think that's quite clear to me that there was an element of negligence there. Wow. Whilst if it's, I've documented it, these are my forecasts, I firmly believe, and all the indications are that I'm going to go from minus 100 to paying everybody off and potentially, breaking even on a balance sheet basis in 6 months' time. Yeah, there's an element of entrepreneurial spirit, and the UK legislation is built up for that in the same way that it's built to catch those who are not being diligent directors.
So the other bits that we wanted to touch is personal guarantees. Yeah. I see this so many times where a lot of organisations lending money. I'm going to mention one. We're watching Funding Circle, quite renowned for this. We've had some clients have had those challenges where they've lent money to the company and they've asked for a personal guarantee. Mm-hmm. How do you deal with these personal guarantees, and what advice do you give to entrepreneurs around this?
Sure. So when a company goes into liquidation and directors or other stakeholders in the business have given personal guarantees, what happens is those personal guarantees are then called upon by the lenders. Wow. Sometimes I've seen personal guarantees not just by banks and institutional lenders, but suppliers as well. Wow. So at the time that you're taking, you've got that personal guarantee in front of you, I think you really have to give it some thought as to how it may affect you, because it's all well and good signing it there and then, but the figure attached to it can be rather large, and it only comes into play once the company is defaulted. Yeah. So it doesn't even necessarily have to be once in liquidation. It's once the company's defaulted, there can be an approach, a tap on the shoulder to the directors to say, you're now liable for this debt, irrespective of an insolvency or not. And
I've seen that with disastrous consequences to that, so you've got to be careful.
100%.
In summarising, what's your biggest 3 tips for the entrepreneurs watching, maybe other accountants watching? Mm-hmm. What's the 3 biggest things that you see that you just got to make sure people are aware of?
I'd say the first and foremost is know which direction you're heading in. Is the business going in the right way? In order to do that, you need to have the management information to hand. Yeah. You need to be on top of the financials of the company, and in order to do that, you need the right accountant. You need a strong accountant who understands you and your business. Yeah. In order to keep on the straight and narrow. The second for me is knowing when you need help. The same thing applies in life as it does in business. It's good to ask. It's good to ask if you're not sure. It's good to ask when you need help with that direction, if things are uncomfortable. And I think the third thing in business is that you need to still have that passion and that belief. It's all well and good we're talking here about, insolvency and when things go wrong, or, extracting the profits when things go right. But, you still need to have that fire and that desire. And if you don't have that, everything else that we've spoken about is almost irrelevant.
Do you know what? You summarised well there. I see it all the time with entrepreneurs. They've had a good run, and life is tough. And, I know different people watch us in different medium channels and things like this. One of the biggest challenges we see is keeping that passion. You've got to have that passion. And this is why we do the Next Level Finance podcast and get people like Peter and others who are experts in different parts of a business, is to give you insight of the things that you probably need to be aware of, or if you're not aware of, get some knowledge, invest time to become aware of, because if you don't, you're going to have other impacts. So Peter, we're going to put your contact details below when we as we post this video and across all the social medias, and you'll be able to get a hold of Peter and get his expertise. I know he's always open to help many people. He's helped me, my clients, where they've had some challenges, where a lot of life-changing events have happened.
Yep.
And I'm sure that will be consistent going forward, because as we know in life, you just don't know what may happen. You can plan with the best in mind, but you have to sometimes expect some things are going to happen that you're not expecting. So having someone like Peter in your network is going to be quite beneficial, trust me. So thank you, Peter.
Thank you very much.
I really appreciate that. This has been great, and I'm sure the audience are going to love the value when we put this all across. So thank you for watching. Hope you enjoyed that, and yeah, do post your comments below of anything that you want us to talk about further in this, and we can get hold of Peter, or if you need more information about this or any other thing that we've done on our Next Level Finance podcast. And I hope you enjoyed them. Thank you so much.